Hello, and welcome back to Principles of Accounting 1. I'm your host, Dr. B. Today we're going to be talking about analyzing and recording transactions. As you may recall from Chapter 1, when we were talking about this past Tuesday, we discussed how transactions impact the accounting equation. We went through several examples of transactions, using debits and credits and how each transaction requires two different accounts and how those accounts impact the accounting equation, which ultimately are recorded on the income statement and balance sheet. And let's continue that discussion from chapter 1 into chapter 2 by talking about how to read, analyze, and record these transactions. There will be a lot of examples that we'll talk about, and of course I'll also bring in some of my experience I've had in the past. On the recording transactions, we'll also talk about some software that's available to help you, if you ever get into accounting for whatever reason, for your business, because I know quite a few of you own your own business, and sorry, and some of you, either you own your own business or you're looking to get into one, or you're working for somebody else, and there's a lot of software that's out there. Not just Excel. Yeah, of course, Excel's a great piece of software. That's free, openly available to all students, faculty, and staff here at UBC. But in addition to Excel, there's a lot of other accounting softwares that are available to you. And I'll talk a little bit about that as we go forward, because something to understand is accounting, when we record transactions, it's not like the old days. We're not using a physical ledger. We're not using a physical piece of paper and writing down these transactions. Those days are long gone. We use software. We're in the 21st century, right? So, we use software for recording transactions. And we'll talk a little bit more about those different nuances throughout the chapter. So we'll talk about the transactions, how they're recorded, uh, what double entry accounting it is, using debits and credits, uh, and how to interpret those on the financial statements, and how to compute things, and how to solve for various problems. As most of you have already begun to experience by completing the Chapter 1 quiz, you'll realize that there are quite a few computations that you need to complete. And the most efficient way of making these, and all you're doing is adding and subtracting really, is your understanding of the accounting equation will certainly help you to solve for all of your computations. As you recall, the accounting equation is assets equals liabilities plus equity. And within each of those categories, there are several accounts. Assets, as you recall, are what the company owns. Liabilities are what the company owes. And equity is ownership, right? It's the difference between assets and liabilities. Assets include things like cash, accounts receivable, property, plant, and equipment, so forth and so on, right? Things the company owns. Accounts payable includes things like, I'm sorry, liabilities includes things like accounts payable, wages payable, taxes payable, uh, notes payable. Anything else that the company owes to someone else goes into liabilities. There's a couple different accounts. And equity, which is the difference between assets and liabilities, which represents ownership, includes things like common stock, preferred stock, dividends, retained earnings, things like that, right? It's the difference. It's what the company owns. And so we'll talk a lot about those different types of transactions and using those accounts that we just talked about, and how those transactions are recorded on the income statement and balance sheet.
Professor,
Yes, so what?
yeah, I have a kind of like a question. The equity, can it be like your personal things? Is that equity? Can you describe it as that, or?
You can to some degree. So equity is technically what the company owns. So if you are, let's say you own a bakery, okay?
Mm-hmm.
And you at home you have a really nice mixer that you use for baking. And you're like, I'm starting a bakery business. I'm going to bring this piece of equipment that I use from my home into my business.
Mm-hmm.
In that case, yes, you would record um, that piece of equipment as paid in capital, which is a part of equity.
Mm.
So it's what the owner is bringing into the business.
Okay, so equity is what the owner is bringing into the business,
Yes, yes, what
and
the owner is.
assets are the things that you have when you start the business, right?
Exactly. That's when the business first starts off, right?
Yeah.
Because you don't have sales yet. The business just started. So
Okay.
so yeah, that's what the owner brings into the business is called paid in capital. That's what the
Mhm.
owner's bringing into the business. That's one account within equity. Other accounts in equity would include things like any type of stocks,
Mhm.
dividends, and then of course retained earnings. Retained earnings, as you remember from chapter one, is revenue, which is your sales, minus your expenses, gives you net income. Net income is a part of retained earnings. So, good question. Yeah, we'll talk more about it. Excellent, thank you. Okay, so let's talk about sources of transactions. How do transactions start? What are they? A transaction is quite in simple terms. It is an exchange of goods or services for something else, which is usually cash or accounts receivable. But it's an exchange, right? It's an economic exchange within the business. That is a transaction, right? It's like the other day when you went to Macy's and you bought that shirt that you really liked, right? That is a transaction. You paid Macy's cash in exchange for the shirt, right? That's a transaction. And so we'll talk about transactions. We'll identify what they are and analyze them. These transactions, now there's a lot of transactions that happen in business. Think of something like Macy's, right? They have a thousand transactions a minute at least, right? It's a huge company. They got a lot of stores. Uh, there's a lot of transactions every minute. Or think of like Amazon. They probably have a million transactions every second, right? So the idea is we need to record these transactions somewhere, and we do that in this thing called a ledger. A ledger. Think of a ledger as an area where we record a list of transactions. We call that a ledger. It's called a general ledger. And we record these transactions or post them to this general ledger through what we call journal entries. A journal entry is the recording of a transaction. That is a journal entry. The journal information, which includes the uh, debit and credit accounts, are recorded onto what we call a ledger. And it's called a general ledger. And within the general ledger, there are subsidiary accounts. We call these subsidiary ledger accounts. A subsidiary account is simply the name of the account and all the transactions that impact that account. We'll talk a little bit more about that in depth. And
I have a question.
yes, please.
Um, at some point in time, could you post like a template? Because this is one of the things that confused me, like a template for like what a journal would look like and a ledger. And I think there's like a trial balance. because I get those mixed up a lot.
Yeah, absolutely. Yeah, and we'll actually talk about that throughout these next coming slides. But yeah, I'll be
Okay.
happy to post a couple of additional samples.
Okay, cool. Thank you.
My pleasure. Yep. S- So these ledger accounts, they are the individual accounts and they have a record every time that account is affected. So for example, let's say I have a, uh, a business and I sell inventory, whatever it is, right? I sell coffee mugs. Okay, that's my business. So I have a coffee mug sale business. Every time I make a sale, there are there's actually let's think about this. There's actually 4 accounts that get affected with every sale that I make. What do I mean by that? Well, there's a cost of selling, right? There's a cost of, we call that cost of goods sold. And of course, there's inventory. And I impact cost of goods sold and inventory every time I sell something, right? And then I'm also impacting cash or accounts receivable every time I sell something, and sales every time I sell something. So the first transaction would be uh, I would debit cost of goods sold, and I would credit inventory, reduce the inventory. And I would uh, debit cash to increase cash and credit sales, right? Those 2 transactions are actually the same transaction broken up into 2. We do that every time we sell something. And I'll talk a lot more about that as we go forward, but just trying to give you some examples of something that gets affected in the general ledgers. So each ledger represents an individual account. And in that example, there's 4 different accounts that got impacted. And there'll be a date recorded and an amount. A date and an amount, a date and an amount, right? For like things like cash. That's all right, Marina, no problem. I'm actually having internet problems today as well. How do we identify where transactions come from in an accounting system? In an accounting office, think of an accounting office. You know, it's separate from where the registers are. It's separate from where the transactions actually take place. It's an individual office that simply records transactions. Uh, how do they record transactions? Well, there's a couple of different ways. They do it through information that's provided to them. And here's a couple of examples of that. We received a bill from a supplier. What does that mean? So the company purchased inventory. When I purchase inventory, a couple of things happens here. The first thing I do is I issue what's called a purchase order. I'm saying, hey, Mr. Vendor, that sells me the coffee mugs. I'm going to purchase 20 coffee mugs from you. Great. Send me a purchase order. I fill out a purchase order. A purchase order is simply uh, the date, name of the company, how many units I'm ordering, and the cost per unit. The cost of ordering the inventory, right? And some shipping and whatever. And I send that purchase order off to the vendor. A few days later, I receive my order, through UPS, FedEx, whatever. And they come drop off my 20 coffee mugs that I ordered. And in that order, in the box, I'll open up the box, and there's going to be this thing. It's a sheet of paper. It's called a packing slip. The packing slip tells me the quantity, the size, how many I ordered, what condition they're in, right? That's called a packing slip. It tells you what's in the box. So I have a purchase order that I did originally to place the order. Now I have a packing slip that came with the delivery. And then 2 days later in the mail, I get a bill for the inventory that I purchased. So now I have a purchase order, a packing slip, and a bill from my supplier. Those 3 documents represent one transaction. Okay? And in the accounting office, I would attach those 3 documents that represent that transaction to create what we call a paper trail. A paper trail helps the accounting office to audit the transaction, to validate that that transaction happened. Back up exactly, Marina. Marina, you're absolutely right. It's a backup. It represents the transaction. It's a paper backup, right? So I have my purchase order, my packing slip, and a bill from my supplier. So I paperclip all 3 of those together. I enter my bill into my accounting software, my QuickBooks, or my Sage 50 or whatever, right? My FreshBooks, they have so many different softwares now. So I enter my bill into my QuickBooks. Cost Point is another one. And I mark the bill as needing to be paid. And so and on the invoice, on the bill I got from my on the invoice, the bill from my vendor, it says, hey, we delivered it on this date. Here's the quantity, the total amount, the shipping, total amount at the very bottom. And it'll say something like net 30. Net 30. Have you ever heard net 30? Who knows what net 30 is? Terms of payment. That's correct, Mary. Terms of payment. Net 30 means it's due within 30 days. Okay? So 30 days from the date of the invoice. So I enter it into my QuickBooks. Net 30. It's due in 30 days. So within that 30 days, I need to send them a check to pay for my merchandise, right? So 30 days comes up, and my system prompts me and says, "Hey, you got to pay this guy, today for your bill." So I print out the check. I attach the check to those 3 receipts I got earlier: the purchase order, the packing slip, and the bill. And on the front, I got the check. And I go to the financial controller. I say, "Hey, I need you to sign this check. So I got to pay the supplier." So the controller signs the check. She signs the check. Okay. And then I take the check, I put it in the mail, pay the vendor. I've made a copy of that check. So now my paper trail includes the purchase order, the packing slip, the bill, and a copy of the check, right? To prove that I paid the bill on time. So these 4 documents represent one transaction. And that's why when you go to an accounting office, you see, huge filing cabinets. Like, man, what are they doing here? What are they just? Yeah, it's all backup. It's all the paper trail. So then, at the end of the year, I'm like, hey, did that transaction actually happen? I'm auditing my books. I'll be like, well, I remember that transaction, and here's where it is in my filing cabinet. Pull out the filing cabinet, look through, I'll match the numbers, what's in the accounting system to what is on the paper. Right, that's called an audit. So it's fascinating. And then on the other side of the table, right? So now I have my 20 coffee mugs. I'm going to start selling them. So when I sell them, I record the sale. How do I record the sale? Well, I debit cash to increase cash. I credit my sales. In addition to doing that, the second transaction.
I have a question.
Yes, please, pilot.
What kind of account is sales in terms of like accounting equation?
Thank you so much for asking the question. Sales is an equity account.
Okay.
That is revenue. Sales is revenue.
Right. Okay.
Excellent question. Thank you for asking. So, first part of the transaction when I sell a coffee mug to a customer, I debit cash to increase cash. I credit sales to increase sales. The second part of that transaction is I need to reduce the inventory because I no longer have it, right? And that inventory costs something to me to acquire it. So the second part of the transaction is I debit this account called cost of goods sold. Cost of goods sold is found in the income statement, and it represents the total cost to the company for the purchase of that one coffee mug that you sold. That's the cost of goods sold, right? So you debit cost of goods sold and you credit inventory to reduce it in the inventory. You know, because now you sold it, it's no longer in your possession, it's no longer in your inventory. And that represents the sale. Now, when that sale happened, it generated this thing called a sale receipt, right? It's that.
Professor, I'm sorry to cut you off.
Yep, sure.
I do have a question. Can you explain a little bit about why we have to credit sales? I know why we're debiting cash because you're receiving cash, right, when you sell your products. But why are we crediting sales?
Yep, we credit sales because we need to increase our sales amount because we sold something.
Yeah.
We need to represent the sale itself. You can't just put cash in your register and that's it. No, it doesn't work that way. You know,
Okay.
every transaction has two accounts.
To balance it.
To balance it, exactly. So, you know, if I have cash in my bank, that cash came from somewhere. It came
Okay.
from sales. So I need to
Oh,
credit sales to show where that cash came from.
I see.
Does that help?
Yeah, thank you.
Hey, my pleasure. Absolutely. Great question. So yeah, sales receipts represents the actual sale of that. So, you know, when you go to your cash register and you know, when you're purchasing something, the cashier hands you a receipt. The receipt represents the sale, and so the cash the cashier themselves gets a copy of the receipt, and the customer gets a copy of the receipt. Sorry, I'm just trying to follow the chat. Uh, Dario, so you're asking to increase sales.
No, I mean like for the credit, it's like to increase sales, right? That's what you meant.
We credit sales to increase sales. Now,
Gotcha.
Dario, remember the accounting equation, right? To increase an asset, we debit the asset. To increase a liability or an equity account, we credit the liability or the equity account to increase, right? It's the other side of the equal sign. Debit on one side of the equal sign, credit on the other. That's why debits always equal credits. Yeah. Does that help?
Yeah, that helps.
Awesome.
Thank you.
So, Professor, assets are always going to be debits?
When they're increasing. When they
Okay.
decrease, we credit them.
Oh, okay. All right.
To increase asset, we debit. To decrease asset, we credit. Good, great question. So that's sales receipts. Uh, Now on the back of the business, there are two other two other documents I want you to understand.
Professor, I'm sorry. There's a message in the chat. Someone is having a hard time hearing you. I don't know if it's their computer or.
Oh, let's see. Kind of low. Amani, it could be. I don't know what it is. Can everyone else hear me clearly? Loud?
Yeah, but you kind of go in and out. You get loud, then you get low.
Really?
Goes in and it's like it fade out, so I can hear you loud, and then it goes low, and then it goes loud. So I mean, I'm not sure.
Yeah.
Got you. Okay. Thank you. Thank you for clarifying. Um, that's weird. I'm gonna bounce around a little bit, but not too much, right? Let me see. I'm just trying to check my audio settings. Of course, this system's not gonna allow me to do that, right? It could also be the internet connection. There's for some reason, well, we had a lot of storms yesterday that rolled through and lost power twice.
Yeah, it looks like it fades in and out, but I think if you like wear headphones, you can hear it a little bit better than without one. I'm just FYI.
Yeah, it's there's definitely a lot of usage right now. That's affecting the bandwidth, which affects the audio, as you can imagine. Okay, yeah, let's see what we can do to get through it. Unfortunately, I don't have an easy fix to that, but I'll do my best to stand as close as I can to the mic, either way. Sorry. uh, so payroll. Payroll, as you know, is how employees get paid, right? There needs to be a record of payroll. This record represents the amount each employee is getting paid, when they're getting paid, uh, the date they get paid on, right? These are payroll records. We call those payroll stubs. I'm sure those of you who are employed, you've received one at some point in the past, right? It is a record of payment to the employees. And every 2 weeks, thereabouts, we run the payroll record in the accounting office. Payroll record represents the total amount paid to all employees for those 2 weeks. And we need to write journal entries to represent the amount of payroll expense, but also the amount of tax withholdings, the amount that we need to pay the tax agencies, benefit amounts, so forth and so on. So that's why payroll records are very, very important. We'll talk a little bit about that. We won't go too deep into payroll in this course, but I will show you how those journal entries are recorded and how payroll impacts the income statement and balance sheet. The last one on here is bank statements. At the end of each month, a bank statement is generated. The bank statement represents the cash balance in your bank account. It represents all of the cash coming in and cash going out of your bank account based on the transactions, right? The cash coming in, yeah, it's part of the cash flow. That's right, Marina. And it's not the whole cash flow, but it represents the cash coming in and going out of the business, and that's basically from the operating cash flow. The bank statement shows cash coming in from your customers, in the form of actual cash or checks. That's part of the sales, right? And then cash going out of the business for the payment of various bills and expenses. And I think there's a couple of images I'll show you what each one looks like. But let's break down an account a little bit further. And we'll break down what an account is, what a general ledger is. So an account is a record of an increase or a decrease to a specific asset, liability, equity, revenue, or expense. It's a lot of accounts in every business. These are listed on this thing called the chart of accounts. The chart of accounts represents all of the accounts used within that business. We have assets. Assets, as you know, are cash, accounts receivable, property, plant, equipment, anything the business owns. Cash is its own account. Accounts receivable, it's its own account. Property, its own account. You see where I'm going with this, right? Those are all accounts. Cash, account. Accounts receivable, it's an account. It's its own account, right? That's the idea behind it. Liability, same exact process. Liability, we have accounts payable, wages payable, taxes payable, notes payable. I can keep going, right? Mortgage payment, whatever. They're all liabilities. Anything the business owes to someone else. And those are all individual accounts. The same with equity. Within equity, we have things like common stock, preferred stock, paid-in capital, net income, retained earnings, right. Those are all equity accounts. And then revenue, we have things like sales, that's a revenue account. We have things like rent revenue. Let's say the business is, you own an apartment building and you collect rent every month. Rent revenue would be your revenue account. There's a couple of other, other revenue. Those are all revenue accounts. And then we have a lot of expense accounts. We have expense accounts. Some examples would be utilities expense. That's your electric, your water bill, your gas bill. Those are all utility expenses. We have rent expense. We have wage expense. We have, I can keep going, right? There are so many different kinds of expenses. Office supplies expense. Advertising expense. These are all individual accounts and they're all expenses. And revenues and expenses are on your income statement. Assets, liabilities, and equity are on your balance sheet. All of these accounts are individual accounts. That's where they live. That's what an account is. And these accounts are recorded on this thing called the general ledger. The general ledger, think of it like a book. A general ledger is a book. And it's a blank book, and it's got a bunch of blank lines on it. That's a general ledger. And I record the transactions on that general ledger by account name. We're good so far? Tyler?
Yes.
Okay, great.
I have a question.
Go ahead, Tyler.
If I'm an owner of a business and I would draw money, to use for my own personal whatever's,
Sure.
am
Owner's
I,
control.
is it a debit to that account?
Yes, it is. Yeah, it's a debit to owner's
Okay.
control and a credit to cash.
And okay.
Yeah, great question. Absolutely. Well done.
Yeah.
Okay, so let's take a little bit a closer look, right? So this is a nice visual representation. Under asset accounts, we have cash, accounts receivable, notes receivable, inventory, prepaid accounts, supplies, which is also called inventory. I'd rather the book called it inventory. Let's call it inventory. Supplies is inventory. Investment in land, equipment, buildings, land, patents. Go on, right? These are all asset accounts. I want to focus in on a couple of these. Cash, as you know, is physical cash. Accounts receivable is when a customer owes you the business money, right? Accounts receivable, you expect to collect that account receivable. Notes receivable. Note receivable is a little bit different. That is what, like, if the business, let's say Tyler owns a business, okay? And Tyler took a loan from his business. He's borrowing money from his business. Okay? That would generate what we call a note receivable because Tyler needs to pay the business back, hopefully with interest. And so that's what a note receivable is.
Question.
So,
Oh, wait, who's first?
Who wants to go first? Oh,
um, Professor, about the note receivable. So the example that you gave about Tyler's own company, right?
mhm.
So he's owning his own company. Is that what you said?
Yeah, he's the owner, and he borrowed money from his
Money
own
from his
company.
own company. Okay.
He's got to pay that money back. So
Oh,
so that's why it becomes a note receivable because the company
okay.
will receive the asset back.
Okay. See, thank you.
You're welcome. Good question. Go ahead, Tyler.
Okay, so is a note receivable? Hold on. It's
So
it's like, is that the same as like accounts receivable, or is it like a separate?
it's different. It's a separate account. A note receivable is when the company issued a loan to someone. Okay.
It's specifically a loan when the company issues out a loan.
When you see the word note, it means it's a loan.
Okay.
Yeah.
Okay. Thanks for the
A
clarification.
note is a loan.
Okay.
Yeah. Great question.
I also have a question about that. Is that the same as, for example, if an employee mistakenly uses for whatever reason, like a corporate card, and they use it for their personal item, and they have to pay the company back the same as
Correct.
the notes receivable? Okay.
Absolutely. Yes. Yep. It would still be called a notes receivable. That happens from time to time as well. Yeah, I've seen that.
I had another question.
Go ahead, Tyler.
So this is being recorded as notes receivable in the accounting department of the business that gave me the loan, right?
That's correct.
Because wouldn't it be notes payable if I was the one doing the accounting? Because
Yeah.
as a business owner.
So if Tyler borrowed the money from the business would record it as a note receivable because Tyler
Okay.
owes the business money. On Tyler's books, Tyler would record it as a notes payable.
Okay, cool.
Yeah, great question. Uh, Inventory. That's hopefully very obvious. Inventory is when the business sells products to other people. That's inventory. Prepaid accounts. Okay, this one gets a little bit different. Some people, when you hear prepaid means I paid a bill in advance of it coming due or being consumed. Here's an example. Insurance. Many of us, especially in business, we will pay our insurance for a full year in advance. Okay? So like in December, I'm going to get my insurance bill for the year of 2022. I will pay that full bill in advance. So in December, I write a check to the insurance company for all of 2022. Okay, cover the whole year. For my business, that's called a prepaid expense. A prepaid expense is an asset, not a liability or an expense. Prepaid expense is an asset, not a liability or an expense. Here's why. Okay? Prepaid insurance expense is an asset to the business because I can always cancel that insurance policy and that money comes right back to the business. That's why it's an asset. Yeah, it means, yeah, exactly. So, prepaid. When I prepay something, I'm paying it in advance of it becoming due or uh, yeah, in advance. I could always then cancel that insurance policy and that money is returned to the business. And that's why it's an asset. It becomes over time as the insurance is consumed or used. So for example, at the end of January, I've used 1 month of that prepaid insurance. So what happens is I need to create a journal entry, which is called an adjusting entry. And what that adjusting entry does is I will debit insurance expense and credit prepaid insurance at the end of each month as it's being consumed.
Question.
Go ahead.
So if I'm initially so the first step of that of what you just said, if I prepay my insurance and prepay, let's call it a prepaid account or prepaid insurance, whatever, it's an asset account. So I'm debiting that account. What am I crediting?
Cash. You're paying cash for it.
Huh?
Cash. You know.
So it's both on the asset side, right?
That's right. Yep. So it's net
Okay.
zero.
What do you call those types of accounts?
They're asset accounts.
But it's one where it's like you debit one and credit. Isn't it like contra something? Like I thought there was a name for it.
Contraflow. Yeah.
It was what? I'm sorry, I couldn't hear you.
Contraflow account. But a
Okay.
contraflow accounts are only for accounts receivable and accounts payable.
Okay.
Good question. Contraflow. Yeah, that's the term. Excellent question. So that's the idea behind prepaids. Prepaid is an asset until it gets consumed. Right? That's the idea. And the same, oh my goodness, and I'll talk about when we get to liabilities. The same can be said with liabilities, but it's the opposite, and I'll explain that here in a second. Supplies, that's like office supplies, like a computer or office furniture or something like supplies, a large ticket item that is used to generate revenue. That's the kind of supplies they're talking about. Land, equipment, buildings, land, pets. Those are all assets, right? They're all the idea of an asset. For something to be called an asset, it needs to be used to generate revenue. It needs to be used to generate revenue. I use cash to make sales. How do I use cash to make sales? I purchase inventory. I invest into the business. And all of those things helps me to generate more revenue, more sales. Inventory. I use inventory to make sales because I'm selling inventory. Prepaid insurance. I'm using the insurance, the prepaid amount, to ultimately generate sales. It's part of the business. When something helps you to generate sales, we call that an asset account. That's the idea behind assets. Liabilities. Liabilities, as you know, is anytime the company owes money to someone else. Accounts payable. That's when we sold something to the customer. Customer has not yet paid us. That's an accounts payable. Oh, wait, I'm sorry. That's accounts receivable. Accounts payable. We received the bill and have not yet paid it. For example, I got my electric bill the other day. It's due. It's due next month. It covers half of the previous month and half of this. That is an accounts payable, right? I got the bill, haven't yet paid it. This other one you may not have heard yet. Short-term notes payable. Okay, I'm going to break it down for you. Let's say that your company took out a loan from the bank. Go ahead. Question? No, you're okay. All right.
Professor, I had a question. I put it in the chat, but I guess you didn't see it. I was asking if notes payable will be under liabilities.
Yes. Yep. Anything payable. Anytime the business owes someone else, it's a liability.
Mm-hmm.
So notes payable is a loan.
Like for example, the example that you gave about Tyler's company. I mean, him getting a loan from his own company. So if he's gonna record that on his side, it's gonna be under liabilities,
That's
correct?
right. Yep, because
Okay.
Tyler has to pay the company back. Yep.
All right, thanks.
Great question. Okay, so short-term notes payable. Here's how that works. Let's say the company took out a loan. The loan gave the company cash. So we debit cash by the loan amount, the amount of cash the company received from the loan. The company has to pay that money back. Obviously, it's a loan. The loan is for 5 years. Okay, 5 years, 10%, $50,000, whatever. Okay, 5 years. The loan is for 5 years. Earlier, I had said, with the last class, I had said, anything greater than 12 months is considered long-term. In accounting, anything greater than 12 months is considered long-term. Short-term is 12 months or less. Accounts payable is 12 months or less because we're expected to pay our bills regularly, right? That's accounts payable. Short-term notes payable is the current portion of the long-term debt. I'll say that again. Short-term notes payable is the current portion of the long-term debt. In other words, if I have a 5-year loan, the first year of that 5 years is the current portion. I need to pay that current portion within 12 months. Make sense?
Question.
Yes, please go ahead.
So I don't know if it's really that specific, but does short term start at less than a year
Yes.
or at a year and less?
That's pretty specific. It's a year or less. So whatever
Okay.
whatever that most recent 12 months is considered to be the short-term amount.
Okay, that makes sense. Only because, like, yeah, when with your example, you said it was a year. I'm like, I didn't know if that was long term or short term.
Got you. All right, cool.
Stretching that. Okay, thank you.
You're very welcome. Okay, this next account under liabilities, unearned revenue. Unearned revenue. Remember the matching principle that we talked about in chapter 1. Revenue, sales. Sales revenue is earned when we've either performed the service or delivered the good to the customer. That's when it becomes earned. I earn my pay because I worked, right? Revenue is earned when you've either delivered the good or provided the service. That's what makes it earned. Unearned revenue is when the customer has paid you up front. The customer paid you before you provided the good, delivered the good or provided the service. That is unearned revenue. That is a liability to the company. I want to call it a grant. That's very different. This is like saying, hey, I'm going to pay you before you provide the service. I'm paying you up front. Like, for example, let's say you own a house, and at your house, you have a lawn service that comes and mows your lawn, okay? And they send you the bill, and you pay the bill before they mow the lawn, okay? For them, that's unearned revenue. For the company, that's unearned revenue. They didn't mow the lawn yet. It becomes earned when they mow the lawn. The reason why it's a liability is if they don't mow the lawn, they got to pay you back. Make sense? So if you're the company and the customer pays you before you provide the good or the service, that's unearned revenue. It becomes earned when you provide the good or the service. Now here's how it works. You debit cash because they paid you to increase your cash, and you credit unearned revenue to increase your unearned revenue. Then, after you have performed the good or the service, you would debit unearned revenue and credit sales revenue to reduce the unearned revenue. See how that works? We're good, right? You all understand that concept?
Yes.
Cool.
Question.
Yeah, go ahead, Tyler.
So let's go back to this prepaid insurance example,
Yeah.
because I feel like this is kind of like a flip side of that. What would the insurance, because if I'm prepaying insurance, that means the insurance would debit, cash, and credit unearned
That's right.
revenue, right? Because
That's correct. Yep.
so how would that be reported? Like, say after the first month, they provided me my insurance.
Yep. So after the first month, the insurance company would then debit unearned revenue and credit sales revenue.
They would credit sales.
Yeah, because sales is
Okay.
revenue, remember?
Okay.
Yep.
Okay. Yeah.
That represents
Okay.
them earning it.
Right.
They'll do that at the end of each month. Yep.
Okay.
Great
Sales
question.
revenue.
Absolutely.
Cool. Thank
Okay.
you.
Okay, great. So the next account on here is called accrued liabilities. The word accrued or accrual, because in accounting, there are two types of accounting. There is cash-based accounting and accrual-based accounting. Cash-based accounting simply means that we record the revenue and expenses when we receive cash. That's used by service businesses. Service businesses typically do not have accounts receivable or payable. So like if you're running a restaurant, you're probably not going to have accounts receivable or payable because your business primarily deals in cash. Accrued, the word accrual means we record the revenue or the expense at the time it's earned, right? At the time it happened. At the time it happened. That's regardless of whether we received cash or not at that time. The word accrual means I'm building it up over time, accruing it. I'm building it up over time. An accrued liability is when I am incurring the expense and I'm waiting to pay it. I'm accruing it. I'm incurring the expense before I am paying. An example of that would be wages payable. The employee works for the 2 weeks, and then a week later I cut the check and pay the employee. That is an accrued liability. The 2 weeks that that employee worked is accrued time, right? And so I need to pay that employee for their 2 weeks worth of work. For the company, that's an accrued liability. Then eventually I'll pay that employee and reduce my accrued liability and increase my payroll expense. That's what accrued liability is. And then the long-term notes payable is the long-term portion of the debt. So earlier I gave the example of a 5-year loan that the company took out. It would be that last 4 years of the loan. That's the long-term portion.
Question.
Yes, go ahead.
For accrued liabilities, let's go to the wages payable example. After the 2 weeks that my employee has worked, I would credit whatever they're due for that 2 weeks I would credit accrued liabilities, and then what would I debit? Wage
Yes,
expense?
debit would be wage expense. Yep.
Okay.
Great question. And then of course your second transaction when you pay the employee would be a debit to accrued liabilities and a credit to cash.
Debit.
Actually,
Okay, yeah, that makes sense. Okay.
because you gotta reduce the liability and pay them, right?
And yeah, yep, that
Cool.
makes sense.
Awesome. Great. Equity.
Professor, I'm sorry. Can you go back to accrued liabilities a little bit more, please?
Yeah. What would you like to know about it? So accrued liability is when the liability is adding up over time. So if an employee works for 2 weeks, they're accruing hours.
Okay.
After the 2 weeks goes by, I'll pay my employee. But before I'm not going to pay them every hour that they work. I'm not going to, hey, here's an hour of cash, here's an hour of cash. No, it doesn't work that way. We accrue hours, right? So as the hours are adding up, I'm accruing the liability. In the 2 weeks I pay them. Make sense?
Yeah, it makes sense. So when you have to put that in the record, so accrued liabilities will be what, credited after you pay them?
It'll be debited after you pay them. Remember,
To the debit.
to increase the liability, we credit the liability. To decrease the liability, we debit it.
Okay. And then we have to credit cash.
Yep, credit cash. To reduce
Okay.
cash.
To
reduce
decrease the
liability.
cash because you're paying the employee.
Correct. You got it.
All right. Got it. Thank you.
You're very welcome.
Hey,
Great
Professor, I have one question actually about the accrued liability. So is there an example that doesn't deal with like wages? For example, like if I have to accrue an estimate for an invoice that has not been paid, but I know I have to pay it for like that per certain month, but we haven't received it yet. But then I have to like do the credit debit like for the next month because we haven't received it for the prior month. Correct? That's another way to use the accrued liability.
That's right. Yeah, that would be
Okay.
another example of that. That gets a little bit more confusing because there's certain instances where so much time goes by, you have to accrue the additional payment or interest. That gets very, very muddy. But yeah,
Yeah.
that would be another example of that.
Okay.
Great question. Sounds like that's something you've done before with your business.
I most definitely do.
Yeah, I understand. I've been there. Cool. Okay, so equity. Let's move over to the equity side. The first one says owner capital. Earlier, I gave the example of a bakery. Let's say you own a bakery and you just started the business. Sometimes will use the equipment that we already have at our house, right, to start our bakery business. So the owner brings in a blender or a mixer or whatever into the business. So we would credit owner capital because based on the value of the equipment the owner is bringing in to the business. Or if the business is brand new and we got to get the business started, right? So the owner says, I'm going to take $10,000 out of my personal bank account and deposit it into my business, right? So we would debit cash and credit owner's capital because that's the owner's money bringing into the business, right? So owner's capital is what the owner is bringing into the business, or owners. And also under owner's capital, you'll find that's where you'll also find common stock, preferred stock. That's cash coming into the business from the owners. And remember, stockholders are the same as owners. A stockholder is an owner of the business. Withdrawals. Withdrawals is the owner is taking cash out of the business to pay themselves. Okay, they're paying themselves. That's okay. There's nothing wrong with paying yourself. You own the business. In that case, we would debit owner withdrawal, credit cash, reducing equity, and you're reducing assets. Then we have revenue and expenses. Revenue minus expenses equals net income. Net income minus dividends equals retained earnings. Under equity, you'll have revenue minus expenses equals net income. Net income minus dividends equals retained earnings. Retained earnings is what's represented in equity. That's like the bottom line of that equation. We'll talk more about it a little bit closer to that. Right. So assets, we've talked a lot about it. It's what the company owns: cash, accounts receivable, notes receivable, prepaid accounts, supplies, equipment, buildings, and land. What the company owns. Liabilities, what the company owes. accounts payable, notes payable, unearned revenue, accrued liabilities. Equity, what the owners own or the business owns. Order capital, that's what the owners are putting into the business, whether it be cash or equipment or whatever that the owners own, they're putting into the business. Wages be a liability, yes. It starts as a liability until you pay them, then it becomes an expense. Good question. Dario, does that help to explain your question?
Yeah, no, it's just that I didn't see wages on the liability. That's why I was asking.
Yeah, so it becomes wages payable. So for the employee works for 2 weeks, becomes wages payable until I pay them. Then I reduce that payable, then it becomes an expense. Good question. Owner withdrawals, owners taking cash out of the business to pay themselves. Revenue minus expenses equals net income. Net income minus dividends equals retained earnings. It's all part of equity. Here's a nice visual representation of all of the accounting equation: assets equals liabilities plus equity, and all the various accounts within each one. We're getting there, making good progress. Okay, earlier I mentioned the chart of accounts. The chart of accounts is a list of all accounts that the company utilizes in the order of liquidity, and we'll talk about that when we get closer, but I just want you to understand what chart of accounts is. The ledger is where we record our transactions for each account. So let's take a look. The chart of accounts is a list of all accounts in the order of liquidity. First you have cash, then you have accounts receivable, then you have inventory, supplies, so forth and so on. That's why you see under assets. The chart of accounts will start with assets, and then liabilities, and then equity. It's always in that order. Assets, liabilities, and equity. It's the same order of the accounting equation. But it's a list of all of the accounts used by the business. That's what the chart of account is. We see that there is a number associated with each account. Each account name has an account number. It's a reference number. That's all it is, a reference number. That reference number tells us the number of that account associated with that account name. That's the idea behind the chart of accounts. It's just a nice way to organize all the accounts used by the business. Now, within each account is a ledger. That ledger is debited and credited using the double entry accounting system. Double entry accounting, all it means is
Question.
2 accounts used by each transaction. Yes, go ahead, Tim.
And it actually kind of has to do with this. It's something I was just looking at. So if you're familiar with like the student account like structure, like how it is it like a credit account where it's like it's like the charges?
Yeah, it's a clearing
like-
account. That's exactly what that is.
It's a what?
It's called it's a clearing account.
Okay.
Yeah, that's just what a student account ultimately is until it, is paid and then it goes to the student's record.
So it has a credit balance.
Yeah,
Or the normal balance is a credit balance.
it's right. Yep.
Okay.
So with a student account, it'll typically have a credit balance because it's ultimately it's an account receivable for the company for the school.
Okay.
That's why it's on the right side. Excellent question.
Okay.
Great question. So this is what we're looking at right here. We call this a T account. It's also the ledger account for each account. So it'll say account title on the top. That could be cash, accounts receivable, accounts payable, wages payable, whatever the account name is. That's where the account title is. Okay. On the left side is the debit column. On the right side is the credit column. Think of the way the accounting equation is. With the accounting equation, we have assets equals liabilities plus equity. Any asset account like cash, accounts receivable, prepaid expenses, whatever, right? Anything that the business owns. When you debit an asset account, you're increasing the asset account. When you credit an asset account, you're decreasing the asset account. Debit on the left, credit on the right. It's always that way, always. The opposite is true with liability accounts and equity accounts. For example, if I'm increasing accounts payable, which is a liability account, accounts payable is the account title. If I'm increasing it, I'm crediting the account payable. When I decrease it, I debit. So it's, remember the other side of the equal sign. Positive on the left of the equal sign, minus on the right. It's a nice way of thinking about it. So here's how it looks. Assets equals liabilities plus equity. The increase in asset account, we debit it. And it normally has a debit balance. Otherwise, we're in trouble, right? My cash account is always positive. Therefore, there's always a debit entry. It always has a debit balance. Otherwise, we're in trouble, right? So for assets, it normally has a debit balance. To increase an asset, we debit. To decrease an asset, we credit. That's why you see the plus and minus in the bottom of this slide. This slide will help you a lot, I promise you, especially when it comes to the homework assignment. Liabilities. Liabilities, to decrease a liability, we debit. To increase a liability, we credit. See, you see what happened, right? Once it reached the other side of the equal sign, the signs change. That's how assets always equals liabilities plus equity. Make sense? You'll understand that, right?
Professor, I'm a little bit confused.
Okay, tell me, Alwa, where are you confused?
So about the liabilities, I thought like when you want to decrease liabilities, you have to debit, right?
That's correct, yep.
Oh, okay. It's actually the same thing here too. Debit for decrease and credit for increase.
For liabilities and equity, that's correct. And it's the opposite for assets. That's why it's on the other side of the equal sign.
Yeah, okay, got it.
Yeah, good question. No, it's good. You know, it's important that we're all clear on this concept. Very good. Okay, that's the whole foundation, really, of everything we do in accounting. It's all around that accounting equation. You know, now you know how transactions impact the accounting equation. And yeah, that's very good. Very good. Okay.
I have a clarification question,
Yes, Tyler.
and it actually has to do with the question somebody asked in the chat.
Oh, I'm sorry.
So when it comes to liabilities, and I think you cleared this up earlier on. Liabilities are because I feel like there's a general confusion between liabilities and expenses.
Sure.
Liabilities are like what's owed, but you don't necessarily lose cash from it.
That's correct. Yeah. So
Whereas the expenses you typically pay cash.
typically, yeah. But I also want you to understand is that the liability eventually becomes an expense.
Okay, right.
Because when you pay the liability, it becomes an expense. An example would be wages. Okay, so here's how it works. There's two transactions that happen with wages and anything else that we pay, really. So we got the bill. Okay, I'll give you two examples. You know, when it becomes liabilities and it turns into an expense. The first transaction is we record the expense and the liability. Wages, for example, 2 weeks goes by, we debit wage expense and we credit wages payable. We're recording the expense and we're recording the payable at the same time. Okay, The second part of that transaction, the second transaction is we debit wages payable, reduce payable, and we credit cash. So we're recording the expense as it's being incurred. That's the part of the matching principle, right? So that's where some of the confusion is when it comes to the difference between liabilities and expenses. Remember, a liability is anytime we owe any money to anyone else. That's a liability. We incur expenses separate from liabilities, but we incur a liability and an expense at the same time when we haven't paid it yet. Does that help to clarify?
Wait. Okay, so go over that one more time. You said if I owe an employee wages, I have to credit the liability and debit the expense at the same time?
Yep. So we debit
Okay.
expense, credit liability, wages payable.
Credit wages payable. And then when we pay it,
we debit wages payable to reduce the payable, and we credit cash to reduce your asset.
and credit cash.
Yeah.
What happens to the expense portion then?
Oh, I'm so glad you asked that question. So the expense stays there. So the expense will stay as an expense until the end of the month. At the end of the month, we take all of our expenses and our revenue from our income statement and we close them out through the closing process.
Oh, right. Okay.
Those go on to the balance sheet as equity within retained earnings.
Okay.
Yeah.
Okay.
You're getting a little ahead of ourselves, but yes, you're on the right track. Cool. Great questions. Great questions. Okay. So, and of course, here's what it looks like expanded. So assets increase with debit, decrease with credit. Liabilities and equity decrease with a debit, increase with credit. It gets a little bit more complicated with equity because there's because of paid-in capital minus withdrawals plus revenue minus expenses gets us to retained earnings, and retained earnings is a part of equity. So that's why we see to increase, like for example, to increase your sales, your revenue, we credit sales. To increase your expenses, we debit expenses. But if you look at the greater part of the equation, paid-in capital minus withdrawals plus sales revenue minus expenses equals net income. You see where I'm going with this. So the equity part gets a little bit confusing sometimes. So it's just important to understand what is a normal balance. Here's a nice example of a cash account. So as you know, cash gets impacted over time. Actually, this, it'd be nice if this slide had dates next to each transaction. But we can see that cash normally carries a debit balance based off of the transactions that have impacted cash over time. Which leads me into another part of the conversation is there are what we call permanent accounts and temporary accounts. Permanent accounts simply means that the account will always exist. It will always have a balance, regardless of what happens. For example, that would be cash. Or other all balance sheet accounts are what we call permanent accounts. They'll always be there. Yeah, they'll always have a balance. Temporary accounts will have a balance for a temporary amount of time. Those accounts are on your income statement. The reason why it's temporary on the income statement is at the end of each month, we zero out our revenue and our expenses. The reason why we do that is because we need to, according to the matching principle, we need to ensure that our revenue and expenses are only allocated for the month that they were incurred in. So, but you know, when you're running your QuickBooks or your whatever for your business, we start the next month at 0 for sales. You don't start with 500,000 from last month. It doesn't work that way. Otherwise, you'd have a running total. You don't want a running total. I mean, you do, but you don't. Not on your income statement, because that violates the matching principle. That's where reconciliation comes in. That's correct. Yep. And that part comes in at the end of each month, where we balance our statements. We'll talk more about that when we get closer, but we're on the right track. So this T account, cash, shows us that we have a $4,800 balance of cash. It's on the debit side because it's, you know, the normal balance for a asset account is a debit. On the debit side, it's cash coming in. On the credit side, it's cash going out. To increase an asset account, we debit. To decrease an asset account, we credit. So cash coming in minus cash going out gives us a balance. The same exact process would apply with any. Okay, let's talk about journalizing and posting transactions. First step, identify your source documents. We talked about that. You know, your receipt, or you know, your purchase order with your packing slip, with your invoice and your check and all that stuff. Your source documents. We analyze those transactions. What type of transaction are they? Then we record the journal entry, and then we post it to our ledger. Posting is like validating. Recording the journal entry, as you know, anytime that we record a transaction, there are two accounts affected. There's a debit account and a credit account. The two must always be in balance. In journalizing, you know, as we're recording the transactions, there's a couple of key things that you need to have on your record when you're journalizing. The date of the transaction. The date is super important. The reason being is because in accounting, we must recognize the transaction at the time it was incurred, at the time it happened. So we need to write the date of the transaction. First step. Second step is record the names of the accounts being impacted. In our first example on December 1, 2019, we had what it looks like our owner invested cash into the business. Maybe the business was just getting started. That's probably what it was, right? So this is probably a brand new business. Cash, the owner's putting cash into the business to get it up and running on December 1. So we debit cash to increase cash. We credit paid in capital. Paid in capital. Debit cash to increase cash. Credit paid in capital to increase the paid in capital amount. So I'm recording cash as my debit account because I'm increasing the asset. And I'm crediting paid in capital to increase the paid in capital. So that's the second step is record the two accounts, the debit account and then the credit. Debit account always comes first. Always comes first. Debit becomes before credit. Debit, then credit. Debit, then credit. Debit account always comes first. Anytime you record a transaction. For debiting cash, $30,000 is what the amount that the owner's bringing in. So in the third step, letter C, we record the dollar amounts. Debit $30,000, cash. Credit $30,000, paid in capital. Remember, debits must always equal credits with every transaction. Debits must always equal credits with every transaction. And then the fourth step is a note. The note explains the transaction and what the transaction was for. Notes are really important because sometimes you'll forget what it was for. Gotta have notes. Okay. Earlier I had mentioned, I had described the T account, right? Then we have the name of the account and then we have all of the transactions. This is what that looks like in a little bit more detail. So here's your cash account. This is a ledger for the cash account. On the left side, you see the different dates. On the right side, we see the cash coming in and the cash going out. On December 1st, our owner deposited $30,000. We debited cash and we credited paid capital. The second transaction, it looks like we purchased some inventory, $2,500. We would debit our inventory account and credit cash. On December 3rd, it looks like we purchased something else for $26,000. But you see that this general ledger only shows what's happening in the cash account. There will be another general ledger to show you what's happening in those other accounts. There's a general ledger for each account. And it's just simply a list of what's happening within that account, right? And you see on the very right-hand side, the balance. Going up, going down, and then the final balance.
Question.
Taylor?
Is there typically like an order to the type of accounts that are posted on like the,
Yes.
I don't know. Okay.
Yep, and the order is always what we call by liquidity. Liquidity simply means how quickly I can convert something into cash. So we start with all of our assets. At the top of the assets, it's always cash. Next would be accounts receivable, then it would be inventory, then it would be supplies, so forth and so on.
Okay.
Good question. So, just as I said earlier, each ledger represents that account, right? We got, so to show you what happened with that first transaction, we deposited cash. The owner deposited cash, 30,000, okay, into the company. On the cash ledger, we debit 30,000. On the capital ledger, we credit 30,000. And think of the ledger as like running total. So what happens when we record transactions? What happens to the accounting statements? The income statement, the balance sheet, the statement of cash flows. For every transaction, there is an impact to either the income statement, balance sheet, statement of cash flows, or all of them. Mostly all, typically all of them. So step one, identify the transaction in the source document. Step two, analyze the transaction using the accounting equation we've been doing. Step three, record the transaction in the journal entry using double entry accounting. Remember, there are two accounts, that is double entry. Two accounts, double entry. There's a debit account and a credit account. We call that double entry account. In step four, we post it to the accounts, to the T accounts. This is basically showing you the steps that we just walked through. Yeah. Source documents, 30,000 cash from the company owner. We debit cash, increase cash. We credit paid in capital, increase equity. Step three, we record the transaction using a journal entry, debit cash, credit paid capital. Step four, we post those to the ledgers. Here's another transaction. This is the second transaction. We purchased supplies. So we got, purchase order, packing slip, invoice. And we paid it. Looks like we paid it right away. So the second one is we're going to subtract $2,500 from cash, increase our supplies, $2,500. So debit supplies, increase supplies, credit cash, decrease cash. These are both asset accounts, and then we post those to the general ledger. It's the same exact process with every transaction. The process never changes. Identify your source documents, then we analyze the transaction. What's going to be the impact, right? In this example, we purchased equipment for $26,000 using cash. Otherwise, it would say something like on account, right? Subtract cash, $26,000. Increase equipment, $26,000. We record the transaction. Debit equipment to increase equipment. Credit cash to reduce cash. And then we post those to the general ledger. And you can see what's happening on the general ledger side. You know, what's happening with cash, for example. The first transaction was an increase of $30,000. The second transaction was a decrease, $2,500. The third transaction is a decrease, $26,000. Think of your ledgers as running totals. Step 4, running totals. Fourth transaction, we purchased supplies, $7,100. On account, on account. When you hear the words on account, it means we're purchasing it using accounts payable, and we will later pay the bill. Okay, on account. Anytime on credit, on account, they mean the same thing. It means we're going to use accounts payable to make that purchase. We'll pay them later. We'll get the invoice, and then we'll pay. Purchase $7,100 on account. Increase supplies, $7,100. Increase accounts payable, $7,100. Debit supplies to increase supplies. It's an asset account. Credit accounts payable to increase accounts payable, liability account. And we see the running totals here. We're posting them to our ledger. Transaction number 5. We're receiving cash from our customer for consulting services that we provide. So we debit cash, increase cash. We credit revenue, sales. In this case, consulting revenue, it's the name of the account, $42. Debit cash, increase cash. Credit your sales account, your equity account, $42. We see the running total. Sorry, this one's a little bit more blurry, so I think it's either my eyes or it's blurry. It's blurry, right?
Yeah, it's blurry.
Yes.
Okay, good. I'm not having a heart attack, so that's a good thing. Okay, because I'll tell you what, this is real blurry. I got a little nervous there at first. Okay, so in this transaction, we are paying rent for the month of December. So we're going to reduce cash by crediting cash, and we are going to debit our expense, rent expense. So third transaction, debit rent expense, $1,000. Credit cash, $1,000. Rent expense, as you know, is an expense account which falls under equity, ultimately. So, and as you recall, expense accounts may have a normal debit balance. Expense accounts have a normal debit balance. Revenue accounts have a normal credit. Go ahead, Abba.
So what is this number? 640 and 101?
I'm sorry, what? Can you repeat that?
640 and 101.
These are the account numbers.
Oh, okay.
Numbers for the accounts. Good question. Just the number of the account. Good question.
Professor, before you move forward, for number 4, when you're posting it, the T accounts, the rent expense, why is it only one side? Why don't you put it on the other side too, just to balance it?
No, so with T accounts, these are ledger accounts. They're like running totals. They're running totals. They're not journal entries. They're running totals.
Okay, so we just put rent expense 1,000 and the cash. That's where we have to do the calculations and subtract and have the balance. Because with the cash, we did on the other side, I mean, the debit side and the credit side. So, but the rent one, we just did one side.
Correct. So I'll explain this one more time for you, to help you to clear it up.
Okay.
You see that there's 4 steps here, right? First
Yes.
thing, we identify the transaction, then we analyze it, then we record it. When we record it, you see that the debits equal the credits, right?
Yes.
Okay. It's in balance at that point. When we post to our ledger, the ledger is a running total. Expenses normally carry only a debit balance. Cash, we're reducing cash, but we're crediting cash. You understand? There is no need to balance with respect to the posting.
Okay.
Does that help?
I'm not sure. I still don't. Um. Um. So the first step, the second one, analyze, right? So I know cash is reducing, right?
Yep.
So we're crediting cash, that means cash is reducing. And then rent expense is gonna be credited.
It's debited.
It's gonna be, I'm sorry, it's gonna be debited to decrease credit. Am I saying that right?
No, that doesn't make any sense. Okay, let me help you understand this. Under equity, we have paid in capital minus withdrawals plus revenue minus expenses. That's all under equity. That's why it says minus expense.
Mm-hmm.
When we increase an expense, we're debiting the expense account.
Okay.
So if you go back to, there was a slide that explained this really good. Remember, we're on 32. If you go all the way back to slide number 18, slide number
Okay.
18, under equity, you see that under expenses, it has a normal debit balance to increase the expense.
Okay.
Does that help a little bit more?
Yeah.
Okay.
Yeah, it does. Thank you.
You're very welcome. Knew we would get there eventually. Okay, let's try to, where was I? Was it here? No. Wait, it was
It was number 6.
number 6. Thank you so much.
I have a question.
Yes, please.
Would there ever be an instance where you debited revenue and credited expenses? Or do they just complement each other?
So no, that would never happen.
I didn't think so because it's the same with the withdrawal and the owner's capital. They're like opposites of each other. You would debit it, the withdrawal, and then if it was going to increase, it
Never
credits.
increase revenue. Well, no, you wouldn't do that. It just wouldn't make sense.
Yeah. Okay. That makes sense.
Once in a while, you might credit an expense account, but that's to reduce the expense if you made an error.
Right. Yeah. Okay. That would make sense.
The only time that would happen is if you made an error. You know.
Okay.
That happens when we call reversing transactions, and that the reversing entries, and that happens once in a great while when there's an error. Good question.
Okay. So you account for errors, like record that as like an entry?
Absolutely. Yeah, you never
Okay.
delete anything. Don't ever delete anything in accounting. That is
Okay.
very, very dangerous. Don't ever do that. You would just simply reverse the entering.
Okay.
Yeah, good question. Here's another example. We're paying for an expense using cash. So this example looks like we're paying an employee using cash. So in this case, we're just debiting the expense and crediting cash. That happens once in a while. Sometimes if it's a cash-based business, they don't accrue things. So they just record the expense and pay the cash out. So that's an example of that. Transaction 8 looks like we are consulting and receiving We provided consulting and rental services. What the hell are we doing there? That's weird. Okay. We're renting something out. It looks like. So two different forms of revenue. We debit accounts receivable, credit the revenue accounts because we did it on credit. When we sell something on account, it's accounts receivable. And eventually you'll receive cash from the customer later on. And here's that. Now we're receiving cash a couple days later from our customer. Debit cash, credit, accounts receivable. And all this gets posted to the general ledger. Remember, the ledgers are just running totals. This example, we are paying partial payment for an accounts payable. Debit accounts payable to reduce payable, credit cash to reduce cash. Good, a little bit more clear. I can see again. Transaction 11, owners withdrawing cash from the business. They're paying themselves. That's nice. Look, it's Taylor. Spelled his name differently, but debit withdrawals to increase withdrawals and credit cash to reduce. We're receiving cash for future services. This is unearned revenue. When you see future services, that means unearned. Debit cash, credit, unearned revenue. Of course, it gets posted to the ledgers. Paying cash for future insurance coverage. This is prepaid insurance. We're paying for future insurance coverage. Debit, prepaid expense, credit cash. Purchasing supplies for cash. Debit supplies, credit cash. It's a very straightforward transaction. 15. Paying expense in cash. Debit the expense, credit cash. That's easy. 16. Payment of expense in cash. Debit the expense, credit the cash. Now, out of those 16 transactions, we see the ledgers. We see the impact on the ledgers. We have cash, accounts receivable, supplies, prepaid insurance, and equipment. These are all asset accounts. We total all of our asset account ledgers. Cash plus accounts receivable plus supplies plus prepaid insurance plus equipment. $42,395 total assets. According to the accounting equation, assets must always equal liabilities plus equity. So we total all of our liabilities for the credit side. 6,200 plus 3,000 is 9,200. Plus all of our equity transactions. 30,000 plus 5,800 plus 300 plus 1,400 plus 1,000 plus 305 is 33,195. 33,195 plus 9,200 equals 42,395. Your assets always equal your liabilities plus equity. This is just another way of displaying that, right? The ledger. Now, throughout the accounting cycle, we do this, once we've gone through all of our transactions throughout the month, at the end of the month, we do this thing called a trial balance. A trial balance, the purpose of it is to verify and validate that your debits equal your credits. If the two are ever not in balance, that means there's a problem. That means we screwed something up in the enterings. Happens once in a while, it's part of life. Once in a while we screw things up. That's okay, just fix it. How do you fix it? We make adjusting entries. We'll talk about that. So in the trial balance, we list out the account names. If the account has zero balance, we just put 0, or omit it entirely. It's up to you, but I just put 0. Compute the total debit balance, compute the credit balance, verify that the two equal each other. Here's an example of a short trial balance. Your debits equal your credits. We get all of these amounts from our ledger balances. Then of course we got to look for errors. If debits don't equal credits, there's a problem. Or maybe there's a transaction that happened out of order. Or there's so many different errors that could happen, right? So we go through, we recompute it, we verify that the debits equal credits, that everything was posted correctly, and then, you know, that's the process of looking for errors. Eventually, we'll find an error, and we'll have to make what we call an adjusting entry, and we'll talk about that shortly. But we see the impact on the financial statements as we go along. So on your balance sheet, you have assets, liabilities, and equity. We see the impact of the first transaction on the balance sheet. And then we went through all of those transactions that impacted the income statement, the balance sheet, the statement of cash flows, and owner's equity. And at the end of the account, at the end of the month, we see the totals at the end of the month on our balance sheet. It's all part of the closing process. So to recap, there are four primary financial statements. We have our income statement, statement of stock owner's equity, balance sheet, and the statement of cash flows. Income statement reports revenue minus expenses equals net income. The statement of stockholders' equity represents changes of owner investments and withdrawals over time. The balance sheet represents assets, liabilities, and equity at any given point in time. And our statement of cash flows represents the use of cash coming into and out of the business. And on the statement of cash flows, as you recall from chapter 1, we have operating activities, investing activities, and financing activities. Those are
Question.
the classification of use of cash. Yes, go ahead, Tyler.
What is the difference between those activities?
Yep, so operating activities is the day-to-day use of cash for the business. That would be receiving cash from customers and paying expenses. Investing activities would be the purchase or sale of property, plant, and equipment with cash. And financing activities would be the company's repaying a loan, taking out a loan, or the owners are investing, things like that.
Okay, so cost of goods sold would be an operating cash flow thing.
So cost of goods sold is not actually cash. Cost of goods sold comes from the purchase of inventory. The purchase of inventory would be operating activity, yeah.
Oh, because cost of goods sold and the purchase of inventory amount would be the same, right?
You got it.
Okay.
Good question.
Totally.
On our income statement, we have revenue
Okay.
minus expenses equals net income. This is for a service business. For a retail business or a manufacturing business, we would have revenue minus cost of goods sold equals gross profit minus expenses equals net income. And actually, it's more detailed than that, but this is just a very general summary. Revenue minus cost minus expenses equals net income. Net income shows up on our statement of stockholders' equity. We have beginning balance plus net income minus withdrawals or dividends paid equals ending balance statement of stockholders' equity. And that shows up on our balance sheet under equity. That's how all the statements are connected. Nice little example. It's very
Another
similar
question.
to the one we saw on Tuesday. Go ahead, Tyler.
Could you post like templates of these on your blackboard too?
Sure.
Like
Yeah.
just what they look like?
Do you want them on like Excel or whatever?
Yeah, because I want to know what like I would if I were to make one like where I would have to put what like what the format is.
Yeah, be my pleasure.
Okay, thank you.
You're very welcome. And of course, sometimes there's issues that show up as you're making transactions, dollar sign appearance on financial statements. These are all just formatting issues, right? If an amount is entered inaccurately, shows up as a comma, decimal point, thousands, millions, so forth. These are just possible formatting issues. You really don't have to worry about that for this course. And like I had said earlier, in today's day and age, we use accounting software, like QuickBooks or FreshBooks or cost point, whatever. There's so many different ones out there. It eliminates a lot of those errors for formatting. Go ahead, Marina.
Oh, question. So in my company, we actually do use like two different ways of like recording transactions. One way is the vouchers transaction voucher recording, and then there's the journal entry recording. From what I see in my company, for journal entries, we use them just for like the, the accounts that we reconcile like at the end of the month.
Yeah.
While with the vouchers, like when it comes to vendors, so we can have records of the vendors itself.
Yeah, that makes
So
sense.
yeah, so that's the way that we recorded on my company, but it doesn't have any effect, correct, for
No,
anything. As long as you see it in the general ledger, it should be fine.
that's correct. Yeah, and it should still balance. So when you do the reconciliation, it should still balance. And that's
Yes.
common, Marina. Yeah. Marina, what happens is some companies, what they'll do is they'll wait till the end of the month and they'll do what we call a general journal entry, and it's a very general transaction. You know, uh, we'll debit cash, credit sales, and then we'll have all of the debit entries for all of the expenses and the credit to retained earnings. You know, and that just closes it out for the next month. You know, and that's very common.
Yes.
Yeah, great. Yeah, thanks for sharing that with us. So as we are analyzing financial statements, it's important to compute ratios. Ratios are very important because they tell us as potential investors or as managers or owners what's going on within our company. What is the financial health of our company? That's why it's important to do ratios. This one's very simple. It's called a debt ratio. We take total liabilities divided by total assets. As you know, both are found on your balance sheet. Total liabilities divided by total assets gives us a debt ratio. We want this to be less than 1. Less than 1, okay? Greater than 1, got some trouble. That means we can't pay. If it's greater than 1, we got a problem. That means we can't pay all of our debt. So that's why less than 1 is ideal. Total liabilities divided by total assets equals the debt ratio. A lower debt ratio, the better. I hope I didn't have to explain that, but okay. Any comments, questions, concerns? I apologize. I thought we were going to be done like 40 minutes ago, but we had really good discussions, really good examples, I think. Comments, questions, concerns? Chapter 2. Any comments?
None so far for me. I'm following along.
Okay, great. I'm so happy. I love that. You know, I love when you guys follow along and you're having a good time doing it.
I have one question.
Tyler?
Could you go back to the example where it said the accounts receivable was like $1,900? It was like, I think the last trial balance or something.
Let's see if I can find it. $1,900. Well, it was one of the transactions, right?
Yeah.
Yeah. Let me see if I can find it. Oh yeah, that was transaction 9.
It was one of these. Yeah,
Tell me.
okay. So before that one, you debited because it's an asset. So you debit. So because right here, this was before. This is showing the account was paid, right?
Yeah,
By whoever we gave the account to.
you got it.
So
Go ahead.
what do we credit? So when we first made the account, was that for like supplies or service? Like, what do we credit for
Yeah, so
if we're debiting accounts receivable?
thanks for asking the question. So here's what happened. We sold something to our customer on account, right? That's what
Okay,
created an account receivable. So
right.
so we would there's a couple transactions that go along with that. So when we sell something, uh, we are there's two transactions that happen. One is um, we would debit our our we would debit our let me think here. Okay, I'm selling something. I'm selling a product, right? So uh, I would debit my cost of goods sold, credit my inventory account to reduce the inventory because I sold it. I no longer have it. I would then have to credit my sales account and debit my related account, right? Why am I drawing a blank on this? Okay, so let me rewind. If I sold it on cash, I would debit cash and credit sales.
Sales revenue, yeah.
So if I would debit accounts receivable, right? So the first transaction is I sold something on account. I debit accounts receivable to increase accounts receivable.
Yes.
I would credit sales that same amount. The second transaction is I reduce my inventory. I debit cost of goods sold and credit inventory. Those two transactions represent the sale of the product on account. Now later on, the customer's paying me because they didn't pay
Yes.
me with accounts receivable. They just generated a bill for the customer. So the customer's now they're going to pay me. So I debit cash to increase cash, and I credit accounts receivable to reduce their account receivable.
Okay, and then that leaves you said credit accounts receivable. So does that mean sales is what's left over?
Sales to the difference, yeah. But the sale was already recorded. There's nothing left over in account receivable. Account receivable is a contraflow account. So it goes
Yes.
up when the customer owes us money. It goes down when they pay us.
Yes.
Sales
And
doesn't go up and down, it goes up.
yes, and cash is debited once accounts receivable is credited. I'm saying what happens to sales because sales was also a part of
Sales
that.
was already recorded. We already recorded the sale transaction. Remember, we debit account receivable and we credit sales. That's the very first transaction when we made the sale.
Yes, yes, yes. I remember that.
Yep, it's a separate
And so you're
transaction.
saying when we credit,
We debit account receivable, credit sales. When you credit sales,
credits.
that shows sales going up.
Right, right. That makes sense.
Cool.
So if we're crediting accounts receivable, nothing happens to sales. So that whatever
Correct.
credit balance stays.
That's correct. Account
Okay,
receivable.
yeah, that was
Account
my only
receivable.
question.
Yeah. So Tyler, the way to think about it is account receivable. The other side is cash.
Yes.
Yeah. You got
Yeah,
it.
okay. It was just because in terms of giving something or selling a product on credit, we didn't get paid for it, but it was still a sale made. So
You
there's
got it.
going to be a balance.
You got it.
Okay, yeah, that makes sense.
Cool. Great. Awesome. Any other comments, questions, concerns? We're good? Okay, so as a reminder, what's due Sunday night? Go into your classroom. Go on the blackboard. You got two things that you owe me by Sunday night, okay? Sunday night, remember your textbook's there, so make sure you get access to your textbook. Sunday night, you should have read chapters 1 and 2, and you owe me the chapter 1 quiz and the chapter 2 homework. Okay, they're both on Blackboard. You don't need to go anywhere. There's no Cengage, no Connect, no nothing. Okay, real simple. You log on to Blackboard, you open up module 1, then week 1, and go through all of these items. Knock them all out. Okay, now great news, you got 2 attempts for both the chapter 1 quiz and the chapter 2 homework. You got 2 attempts. The higher grade will be accepted into the grade book. Are we clear?
Yes.
Yes.
Thank you.
Great.
Yep.
So please make
Yes.
sure you do it by Sunday night, please.
Sir.
You good, Taylor?
Hmm?
You good? Okay, great.
I'm good.
Okay,
I'm good.
thank you so much. Okay, my friends, if you need anything in the meanwhile, you have my email address, you have my cell phone number, you have everything you need to get a hold of me. If you call, I'm not going to answer it because I'm not going to recognize the number, so make sure you leave a voicemail. Best way to get a hold of me is through email, because I'm very quick to respond to emails, or you can get me through the classroom. I'm in here regularly, so under discussions, there's a help one. Yeah. Or if you want to set up office hours, you could do that. Oh, you know what? I forgot to add the link, didn't I? No, it's there. So under start here, click office hours. And then you can set up office hours with me. Other than that, I want to thank all of you for your time today. I apologize for going, a little bit longer than we expected. But I want to say thank you so much. Wash your hands. Yeah, wash your hands. Stay safe. Do all the right things. And I will see you again on Tuesday morning at 11 a.m. Thank you all so very much for your time today. Have a great rest of your day. Bye-bye.